LoanDepot stock, ticker symbol LDI, has been on a roller coaster lately, and Tuesday was another reminder of how quickly sentiment can swing. The shares fell another 19 cents to close the day at $3.29 per share, a drop of about 5.5%. In after-hours trading, the stock continued modestly lower, suggesting that the pressure hasn't eased yet. Now, this is after last week's big sell-offs. We're talking about a near 10% drop on Thursday, a 17% collapse across Thursday and Friday combined, and then Monday's 6% decline. When you string these together, it paints a clear picture. Momentum has shifted. Retail excitement has given way to skepticism, and confidence is starting to waver. But here's the interesting twist. Despite the insider selling, despite the technical breakdowns, and despite analyst downgrades, there are still positive price targets floating around LDI. Some research houses still see upside potential from current levels. That sets up a fascinating clash. Analysts on one side with cautious or bearish price targets, insiders cashing out on the other, and retail traders caught in between trying to make sense of it all. So in this video, we're going to explore the heart of that conflict. We'll look at what the analysts are saying about LDI, what the insiders are doing, and what it all might mean for the stock going forward. Let's start with Tuesday's move itself. Why did LDI fall 5.5%? The truth is, there wasn't a big headline that dropped on Tuesday. No fresh earnings report, no dramatic macro shift. What really drove the move was momentum, or rather, the loss of it. From a technical perspective, LDI has been flashing bearish signals for several sessions now. A MACD death cross, weakening KDJ, and a breakdown of key support levels triggered waves of stop-loss selling. Once the stock broke through 350 on Monday, traders who had their stop set just below those levels were forced out. That kind of mechanical selling accelerates the decline. Add in light buy-side support in the order books, and each wave of selling pushed the price further down. So on Tuesday, we saw the continuation of that pattern. It wasn't so much about new bad news, but rather about the ongoing shift in sentiment and technical pressure. But sentiment doesn't shift in a vacuum. One of the biggest factors weighing on LDI right now is insider activity. Over the past several months, we've seen heavy insider selling from LoanDepot executives, including CEO Anthony Hsieh. More recently, filings like Form 144 disclosures have shown additional planned sales, such as Dan Binowitz's intention to sell 50,000 shares. Now, insider selling isn't automatically bad. Sometimes it's just executives cashing out stock-based compensation or selling as part of prearranged 10b5-1 plans. But perception is everything in the market, and the perception here is that management doesn't have conviction in the stock's upside. That's particularly damaging when retail investors are trying to build a narrative around undervaluation and growth potential. Compare this to Opendoor, another company in the housing and mortgage ecosystem. There, insiders have actually been buying stock. That sends the opposite message. It tells the market that management believes their shares are undervalued and that they're willing to put their own money on the line. It's a stark contrast. So when retail traders look at LDI, they see insiders cashing out. When they look at Opendoor, they see insiders buying in. That comparison makes LDI look weak by association, even if the fundamentals haven't changed dramatically. And this brings us to the analyst side of the story. What are the professionals saying? Well, here's where things get complicated. Many analysts actually have price targets that are far below the levels LDI was trading at just a week or two ago. For example, UBS recently raised its target on LDI, but only to $1.90. That's an upgrade, technically speaking, but it's still well below $3 and change where the stock sits today. Other analyst models I've looked at put LDI's fair value closer to $2, with some even lower. Zacks shows a 12-month average target around $1.98, with a range from $1.50 to $3. So in other words, even the optimistic analyst calls don't point to huge upside from here. In fact, many suggest there's still downside risk, even after the recent declines. And yet, not everyone is bearish. Let's not forget that Citron Research, a very prominent voice, came out recently with a bullish view on LDI, arguing that the company's mortgage servicing portfolio alone was worth $5.50 a share. That sparked a lot of the retail enthusiasm we saw a few weeks back. So which is it? Is LDI worth $5.50 because of its servicing assets, or is it worth $2 because of ongoing losses and macro headwinds? That's the conflict we're facing right now. Here's how I see it. The insiders are clearly taking some chips off the table. Whether that's opportunistic or signaling deeper concerns, it doesn't look good for confidence. The analysts, by and large, are cautious, some even outright bearish. They see LDI as overvalued relative to its fundamentals. And the retail crowd, which had been excited, is now losing steam as momentum breaks down. That combination explains why the stock is sliding. The hype cycle has peaked, and now we're in the disappointment phase. But, and this is important, the fundamentals haven't collapsed. LoanDepot still has $409 million in cash. It still has a valuable servicing portfolio. Its losses are narrowing, margins are improving, and Anthony Hsieh's return as CEO provides stability. And let's not forget the macro backdrop. The Federal Reserve has already cut rates once this year, and they've signaled more cuts may be coming. Lower rates could drive refinancing and home buying activity, which would benefit LoanDepot's business. So while sentiment has soured, the underlying business isn't dead. That means there's still a case to be made for upside, but it's a case that requires patience and resilience, not quick momentum trading. So what's the big takeaway? For me, it comes down to three things. First, analyst targets matter, but they're not destiny. Analysts often take a conservative approach, especially with companies that are unprofitable or cyclical like LoanDepot. Their models might undervalue the optionality in the servicing portfolio or the potential impact of rate cuts. But they're not useless either. When the consensus target is well below the market price, it's a warning sign. And we've seen that play out as the stock has fallen back toward those levels. Second, insider activity matters because it sends a signal. Even if the sales are pre-planned, the absence of insider buying is glaring. If management really believed the stock was worth $5.50 or more, wouldn't at least one executive be buying shares at $3? The fact that no one is makes it harder for retail investors to stay confident. Third, sentiment is fragile. Retail traders can push a stock higher quickly, but they can also abandon it just as quickly. Once momentum turns, it's very hard to get it back without a strong catalyst. For LDI, that catalyst might be earnings, it might be a surprise insider purchase, or it might be a macro shift in rates and housing demand. Until then, the path of least resistance is probably lower or sideways. So where does that leave investors? If you're a short-term trader, the message is clear: momentum has swung against LDI. The technicals are broken, insider selling is weighing on sentiment, and analyst targets aren't supportive. That means risk is high in the near term. If you're a long-term investor, the picture is a little different. You can focus on the fundamentals: cash on hand, servicing portfolio, improving operations, and the potential for rate cuts to stimulate demand. The stock is down more than 30% from its recent highs, which could represent a buying opportunity if you believe in the long-term story. But make no mistake, the short-term ride will be rough. You'll need to tune out the noise and focus on execution and macro trends if you want to hold through the volatility. Let's wrap this up. LDI stock dropped another 5.5% on Tuesday, continuing a string of painful declines. The move wasn't triggered by new news, but by the combination of technical breakdowns, insider selling, and weak confidence. Analysts remain skeptical, with most targets well below recent trading levels, though Citron Research's bullish call still hangs in the air as a counterweight. So is LDI's popularity just a flash in the pan? Or is this a reset before a rebound? That depends on what happens next. If insiders start buying, if earnings show more progress, and if rates come down further, LDI could surprise on the upside. But until then, the momentum is clearly against it, and investors should tread carefully. The story of LDI isn't over. It's just entered a new chapter, one where sentiment battles fundamentals, and where insiders and analysts send conflicting signals. And that makes it one of the more fascinating stocks to watch in the housing and mortgage space right now.